Digital lending platforms have become a lifeline for millions of Nigerians, offering quick, accessible loans through mobile apps and online platforms. But alongside these convenience came a surge of complaints from predatory interest rates to unethical debt recovery practices. In response, the FCCPC rolled out a new code of conduct for digital lenders, establishing stricter licensing requirements, data protection standard, and transparency obligations. The goal is to curb exploitative lending while maintaining room for innovation in the sector. The regulation also seeks to create a level playing field for genuine lenders and weed out illegal operators that have demanded the industry's reputation. Economists note that by balancing regulation with innovation, Nigeria's digital economy can continue to expand, fostering local value creation, building investor trust, and supporting the country's push for a more inclusive financial ecosystem. Well, joining me from our Lagos studio to enlighten us on these regulations' impact on economy is analyst Ayodele Adio. He joins us live now. Thank you so much for your time. Good to see you.
Thank you for having me. It's good to be here.
Yeah, so perhaps a good place to start with is to get to know what the issues are, what specific issues or abuses in the digital lending space prompted this regulatory overhaul, and how do you suppose the FCCPC intends to enforce compliance?
Well, there are two levels of abuses. One from many of the 400, lending companies that have proliferated the Nigerian space, many of whom have Can you hear me?
Yes, go ahead, Mr. Adio. Please go ahead.
Okay, sorry, I was echoed. Okay, great. So many of whom are, currently performing or using predatory lending practices that, seem to be forcing a lot of Nigerians to commit suicide. Many Nigerians have to run away from their places of residence or places of work because they are constantly being harassed and hounded by many of these unscrupulous loan sharks, as it were. These loan companies do not have, specifically declared interest rates. They charge between sometimes 60% and 80% interest rates on the loans that they give out. And when it's time to collect, they add charges that are not declared, and then they hound, those who borrow monies from them until they're able to pay, with names, published across social media with all sorts of threats. Making life unbearable and miserable for those who borrows money from them. So that's one of the most important things that the FCCPC seeks to regulate, to ensure that the players in this space are those who have declared specific interest rates, that understand the rules to play in the ecosystem, and that can be effectively regulated, to harm out all of these practices where they threatened customers and all of that. The second, which is even the more important one, is targeted at the big telcos in Nigeria. As you know, telcos also lend airtime and data to millions of Nigerians. And the FCCPC is arguing that, one, these telcos who lend trillions of millions to Nigerians every year must declare or share data of those who borrow monies or who borrow airtime and data from their platform, so that government can make effective policy decisions based on that data, and to also guarantee, that the data is not being abused by these telcos. The second, obviously, is that these telcos must also sort of patronize or carry along local fintech companies in the rendering of that particular lending service that runs into trillions of naira, a year. The idea is to create a level playing field to allow competition to continue, and more importantly, to resist dominance, of international players that sort of weed out competition in our space and stifle innovation, and to essentially create a level playing field where we can create value within our local economy and support the growth of local startups in the ecosystem.
I'm happy that you mentioned, the need to, to be aware, not to just to stifle innovation. I mean, that's where the concern is. But how do you think regulators can strike a balance between consumer protection and allowing digital lenders the freedom to innovate and expand access to credit?
I think that's a very interesting question that you've asked. And there are case studies that abound across the world. For instance, in India, they did the same thing with their payments, where two major companies dominated the entire payment system in India. And what they did was to put a cap on the market share at 30%. And after they did that, it unlocked opportunities across India where local startups, participated in the value chain. That spurred innovation, it spurred creativity, and created, tons of opportunities for people across the entire country. And it's the same kind of template that the FCCPC proposes, which I thoroughly, completely support, which is to put a cap. Because, for instance, just one company called, Optasia, that has a local partner that supports the lending business for one of the major telcos, processes trillions of naira every year, and they control more than 85% of the market share in Nigeria. And unfortunately, if you put together all the telcos, all of the service providers in the lending business, none of them partners with a local fintech in Nigeria. And that's worrying on two grounds. One, on the fact that you don't have data being shared with the Nigerian Credit Bureau, which means that the lending habits of millions of Nigerians, they do not have a credit history. And that means that banks, mortgage institutions are unable to create financial products that serve the needs, of those particular consumer class. And secondly, is the fact that you have a situation where there's revenue flight out of the country because many of the businesses that are, running these services are not resident in Nigeria. They're either in Dubai or in South Africa, and these monies continue to leave this country, even though the value is created locally. And so essentially, the regulation is put in place in such a manner at which it captures a bit of value locally by putting a cap on the market share of many of these internationally owned businesses so that local fintechs can play and participate in the ecosystem, create value locally, create jobs, and add tremendous value to the economy. And even more importantly, so that the data that is being gathered by these fintech companies can be used effectively for policy making and to also design products that people in that lower rung of the ladder can use. You started this conversation by asking about these loan sharks with predatory lending practices. The reason people continue to flock to those loan sharks is largely because the people at the lower end of the ladder do not have access to credit from commercial banks because nobody's going to give you money if you don't have a collateral. And so we need the data from these lending platforms so that financial products can be created as long as people have their history of loan repayments.
Allow you to go because of our time, Mr. Adio. There's issue of how these particular regulation can address, trust, perhaps bring back trust in the system. That's one. And secondly, quickly, looking ahead, what more needs to be done to create a healthy digital credit ecosystem that supports inclusion, innovation, and economic resilience? Quickly, if you can do that in 1 minute.
Well, I think trust can be built with communication. I like to see that a lot more is being done by, for instance, the Ministry of Communication and Digital Economy, and those who play, in the regulatory space in that ecosystem to engage better, to communicate better, and sell the benefits of the regulation that they are proposing, especially to the Nigerian people who will be the beneficiaries of this regulation. And secondly, you talked about how this can also, if I heard you correctly, support the ecosystem, towards growth and innovation. I think that the bill in itself makes the case on its own. And like I gave an example earlier with practices that happens in places like India, in South Africa, in Kenya, where the big telcos in those countries directly, purposefully support the growth of tech startups in those economies. I think once such is replicated in our economy here locally, you will see the tremendous impact in terms of opportunities created, in terms of jobs created, and in terms of value in the local economy. I think it's a win-win situation.
To let you go, but I mean, I just thought that we should look at some more area of interest in this conversation. I mean, one is that,
Yes.
you know, if you look at, for instance, there is a tension between, you know, consumer protection and financial innovation. So the question, you know, is that how do you strike a balance, all right, between consumer protection and allowing digital lenders the freedom to innovate? That's one. We also need to talk about the fact that many Nigerians have lost interest in online loan apps due to, you know, previously breaches and harassment, like you mentioned earlier. And so how do these new rules, how do you think it will balance and bring back, bring about trust and perhaps be able to restore, you know, trust in consumers as well? I think you need to address that.
Competition is the wheel upon which innovation drives. As long as there's a healthy competitive environment, you will see innovative products that will be unleashed into the market space. And that is precisely what this FCCPC regulation is striving to achieve. Because at the moment, what you have is some sort of a duopoly, or in some instance, a monopoly, because the place is largely dominated by one major global player and has sort of been exclusionary to local fintech platforms. And so once you open that space up by capping the market share for players that come into the economy, you already create a level playing field for local startups to also enter the space and create value, because competition would always lead to innovation. It will always lead to creativity. And then you have a gamut of choices in terms of products, in terms of new lending platforms that the average Nigerian can benefit from. And it's important to also reemphasize that the reason Nigerians, many low-income Nigerians, continue to fall victim to these loan sharks is because they do not have access to formal credit systems. And the reason they do not have access to credit formally is because lending institutions, the banks, the mortgage institutions, do not have a financial history of people in the lower end of the society. And that data is residual with many of these big telcos who have a history of lending airtime and data to millions of Nigerians who pay back. And that data is what we need to be able to plan effectively to service that market. And once that comes upstream, there will be no need whatsoever for the average Nigerian to patronize these loan sharks who charge ridiculous interest rates, who break all the laws and all the rules, who harass and hound their customers. It's a no-brainer. They all will then tow towards formal institutions.
I think a good place to leave it. Thank you so much for your time. Ayodele Adio is an analyst. Thank you for your time on Rise Exchange.